This is the London Fintech Podcast, bringing you practical insights and approaches, stories and inspiration from the innovators who are building the new world of financial services. This podcast is brought to you by NextWave, strategy specialists and solutions for financial institutions. I'm Tony Clark, and this is the London Fintech Podcast. This show is all about stories of innovation and success from the world of fintech. On today's episode, we're shifting our view east, and we have a fascinating conversation with one of the brightest stars of the Asia fintech scene to explore the future of digital assets and the intersection of fintech and blockchain technology. The world of DeFi and crypto is diverse and complex, with its own protocols and language around many of the models, with terms like proof of stake, proof of work, tokens, gas, which can be hard for traditional finance or TradFi folks to grasp, including me. I know enough to ask some sensible questions that will leave it to the experts to explain what's going on and how it all works, which is where today's guest comes in. Today's episode is Asia Fintech and the World of Digital Assets with Qin En Looi. Qin En is a partner at Saison Capital, where he leads pre-seed and seed investments in startups across fintech, B2B, commerce, and Web3. He's an advisor and board director to numerous Web3 startups, and he also co-founded a Web3 growth blog and Asia's first real-world assets conference. Qin was previously the co-founder and CEO at Glints, the leading talent ecosystem in Southeast Asia, which got to Series D. I think it's currently at Series D. And Qin has been recognized by Forbes 30 under 30, honors 27 under 27. I don't know how many of those numbers under numbers there are, but those are two prominent ones. And he's also been featured in TechCrunch, Entrepreneur, Huffington Post, Yahoo News, and many other publications. And in his personal time, and I do wonder how much of that Qin actually has because he's a busy guy, he's also the creator and host of Parents in Tech, which is a chart-topping podcast for parents in Southeast Asia. Welcome, Qin.
Thank you so much, Tony. Pleasure to be on board.
Great to have you here. So you've been described by a former boss as the most dynamic, high-performing, outcome-oriented individual I've ever worked with. The first day I met Qin En, I asked him what he's especially good at, and he replied, I get things done really quickly. I think we can certainly see that from your resume. You've achieved a lot in your career already.
Well, thank you so much, Tony. First time someone has brought up that reference in a long time. But I think I really had that fortune of working together with really great people. And I think speed is definitely one of my strengths as well as potentially weaknesses. But we can dive more into that later.
Yeah, well, let's start at the beginning. So can you tell us a bit about family, growing up and your education, which from my research also seems to have happened at about twice the clock speed of everyone else?
Look, I grew up in a very typical Singaporean and I would say broadly Asian household. Typically what people would call tiger parents. So both my parents are actually in academia. My dad is a college professor and my mom is a middle school Mandarin or Chinese teacher. So as one might imagine, academics growing up since young was prioritized above all else, right? Nothing else mattered other than getting good grades. And good grades I got, right? Throughout, elementary school, middle school, and up to high school. One might almost say that I was the textbook Singaporean student. And what textbook Singaporean students tend to do at the age of 18, it's to take a full ride government scholarship and go to a top US or UK college, which was certainly my path, right? So I took up one of the top scholarships on the Singapore government and was ready to start my journey at Stanford. But as fate would have it, I took a very different path at the tail end of mandatory military service, which happens after high school. Got together with two friends, started what was a fun side project that one day, a friend of a friend, whom we are deeply grateful for, he came to us and said, hey, do you want to turn this to a business? And hey, at 19 years old, if someone offers you money to turn it to a business, you don't ask questions, right? You absolutely jump at it. We said we need X dollars, and he was like, sure. And I remember vividly the first question we asked him is, thank you. How do we incorporate a company? Like that's how much how little we knew at that time. And of course, since then it's a roller coaster ride. I dropped out of Stanford. My two other co-founders dropped out of their colleges. I gave up the full ride government scholarship. had to borrow money from my parents to pay back the government. But I think, it's one of the best decisions I made. I co-founded Glints. Today, Glints is one of the leading talent platforms across Southeast Asia and North Asia, Hong Kong and Taiwan. And yeah, it's been an exciting journey since.
Wow. And it's interesting you refer to that as dropping out from Stanford, because I gather you still got the degree, so you just did it in 2 years instead of 4, and only dropped, I think, 2 decimal points with a 3.8 grade point average, which is extraordinary if I've got that right.
Yeah, so I dropped out for more than 3 years. Then I went back to complete the degree after I left Glints. And of course, the difference is when someone is footing the bill, there is no time pressure. But when you are footing the bill, or when you're borrowing money from your parents at that point to foot the bill, there's a lot of incentive to sort of accelerate it. And I always tongue-in-cheek describe it as, Asians, when we come to buffets, you know how we are like, right? If you pay one price, you take as much as you can. I'm thankful that Stanford, as with many US colleges, allowed that. So I paid one price and I took as many classes as I can. That ultimately led to me graduating in 2 years.
Yeah, so you took the all-you-could-eat option at Stanford and clearly learned a lot. So you've been sort of immersed headfirst in the world of fintech since the age of 19 then, and achieved a lot, had a lot of recognition in the market, and also running your own podcast. Just before we get into some of those initiatives, I don't know whether you do have any time off, but if you do, what do you do to relax and unwind?
Yeah, well, as you mentioned earlier, I did used to run a podcast called Parents in Tech. And that was really because I became a parent actually during COVID. And now I have 2 young daughters, aged 2 and 4. So my time on weekends is really just having fun, watching them grow up and really giving them a great childhood. So yeah, they are my joy and where I spend most of my time outside of work.
Yeah. And at that age, I mean, that really is where you should be spending your free time. And you don't really have a choice either when they're that small. Okay. And let's talk a bit about your professional journey. You've been a founder and an investor. Can you tell us some of the milestones in your career so far?
Yeah. So I spent 4 years building Glints, left due to co-founder disagreement. And as I shared, went back to Stanford to get my undergrad. I think one thing became very clear during my time at Glints, which is I deeply believe in the potential of Southeast Asia. And when I say Southeast Asia, that excludes Singapore, because yes, Singapore is where I grew up, but Singapore it's too perfect, right? It's too clean, it's too nice, everything worked smoothly. But, it was really when at Glints, when I took the company to Indonesia, where we set up an office in Jakarta, that's when I experienced the full potential of a massive and rapidly growing market. So really, I remember the first time going to Jakarta, hating it, right? I was like, what's this traffic? What's all this weather? What's all this pollution? It's just not fun. But, there's a charm to the place. It makes me feel alive. And since then, I've been there at least like 50 times and spent a lot of time there. But long story short, I think, that time at Glints really helped me to develop conviction on the Southeast Asia opportunity, which is why right after graduation, I came back to the region. Started out at BCG, the Boston Consulting Group, first in classic management consulting, but was very fortunate also at that time when BCG was launching their venture building arm in Singapore. It was then called BCG Digital Ventures. These days it's called BCGX, where our mandate was really to work with corporates, the largest corporates, and help them to build startups. So it really sort of played into once again, my founder experience, helping corporates to go from 0 to 1, figuring out blue sky ideas. And that was an incredible journey for almost 3 years. That was when my current employer, Saison Capital, reached out. And I remember the first thing when Saison Capital, first question was, who are these guys? And secondly, wait, they are a Japanese corporate venture capital? Are you going to be kidding me, right? Are you going to take like 6 months to write a 100K check and like go through 8 different committees? Like, I've been a founder, right? And if that's what's going to be, like, I don't even want to be talking to founders because it's embarrassing, right? But really, I'm glad that sort of like that was corrected very quickly. And truly, I think the promise of Saison Capital as being one of the fastest, if not the fastest CVC, spoke very true to me, right? As someone who values speed a lot. So yeah, I took the lead, joined Saison Capital.
We'll talk about Saison in a moment. But it's interesting what you said about contrasting Singapore with the rest of Southeast Asia.
Yeah.
So I have an affection for the region when I started out, and I also started in consulting. I started with Accenture, I did a year working on financial systems projects in Kuala Lumpur in Malaysia, and this was in 1993. So it really was wild east. They were still building the towers. They were actually digging the foundations. They were digging down as a 24-hour building site at the time. So it was all below ground, and it was below ground the entire time I was there. I think sometimes the foundations take more than putting the structure up above. And just really enjoyed the region. And we used to go to Singapore to sort of decompress and get a little bit of sort of Western, you used to call it a little bit sterile. It's just a very clean and safe and modern feeling place. And that was our pressure valve in the other direction. Actually, we used to get there about once a month to sort of feel like we were, I don't know, back in London for a bit. Although the weather was always a lot warmer. So good to hear that. And I sort of, some of what you said there resonated. And now with Saison. So tell us a bit more about that. Because having a Japanese commercial finance company, quite a major firm, investing in the VC startup scene. How did that come about, and how does that arrangement really work?
No, I think credit really goes to my predecessor as well as my current boss, right? I think their foresight started 10 years ago for the Credit Saison Group when they decided that they had already achieved success in Japan and they wanted to branch overseas. So 10 years ago, they started investing primarily in some of the iconic technology companies here in Southeast Asia, the likes of Grab, which is like the Uber equivalent, and also Shopback, right? So I think essentially that journey started with strategic investments for the group. In 2019, they decided to set it up as a standalone separate venture capital fund, which is where they hired my predecessor, who did an amazing job of setting it up. And I was brought on in 2021 for the next chapter of growth. I think one of the key signature traits of it's most CVCs are purely strategic. They purely exist, right, to bring startups, products and solutions into the organization. But Saison Capital was founded on the exact opposite. We are founded on the basis of let's build a venture capital fund that can compete with any other non-CVC out there, with sort of financial performance. Our standalone brand would be the primary metrics where we measure ourselves on. And I think because of that, we have been able to actually achieve the best of both worlds in the sense of getting the speed, the agility of any other venture fund that is relatively lean and quick. But at the same time, we have sort of the unfair advantage of having a large corporate at the back end, whether it's in the form of portfolio support or sort of, just helping us expand our global reach.
And Qin En, do you prefer being a founder or an investor then?
It's very hard to say. I do enjoy parts of both, and I always think about it in seasons of life. I think in this season of life, because I have 2 young kids, I think definitely being an investor gives a lot more freedom, a lot more flexibility, and that's the candid answer, right? But I definitely do miss the thrill, the adrenaline of being in the arena as a founder, being at the center of attention, right, and center of action rather. I think the biggest adaptation, the biggest thing I had to adapt to when I first crossed the bridge from founder to investor is that input does not always equal to output. As a founder, you're always used to that. Something doesn't work, it's our responsibility to do something about it. And usually the feedback cycle is extremely quick. You do something, whether it's in days, weeks, or at most 3 months, you would know whether it's working or not. Unfortunately, the same can be said in investing, right? Investing, especially in venture investing, it's a multi-year process. And honestly, once the investment is made, as much as many investors, ourselves included, always like to call ourselves value-add investors, the truth is, at best, we make 1% difference, right? 99% of the difference is made by the founders. 99% of outcomes are determined by the founders. So I think being out of that action, being not able to control the outcomes, took a bit of getting used to. And I definitely do miss that sometimes.
Yeah. And are you more investing in the founders or more investing in the idea and the market opportunity?
Man, that's a tough one. Honestly, that was another lesson that I made, right? Learned, to be honest. The fact is, when I first started in investing, I was entirely founder focused. I believe that founders make or break. I think that has shifted to be a lot more nuanced. One thing I realized is that market size and market timing, those 2 things are as important as founders, to be honest, right? Of course, at the end of the day, there's no replacement for founders, but we have seen firsthand how some incredible founders just pick the wrong market or pick too small a market and simply can't grow in the way that venture expects them to grow, right? So I think that really sort of is one of the biggest lessons I had. I used to think that as long as a founder has enough resilience, capability, grit, and all those positive attributes, they will be able to conquer it all and build a unicorn. I think it couldn't be further from the truth, right? So yeah, I think that's the reality that I've lived.
Yeah, we see that in our own journey with the consulting business. It's so important. Timing, where you are in the market cycle, and product market fit for your proposition.
Right.
And if the audience are interested in getting a bit deeper on that topic, a couple of episodes back, we spoke with Niall Cameron from Fintech Connect about product market fit at quite some length. And Fintech Connect in the UK are supporting a network of growth firms across the sector. So I have a really clear view on this, and it is super important. Anyway, we'll come back to the Asian fintech scene, I think, a little bit later in this conversation, but we're primarily here to talk about digital or real world digital assets. I get that the right way around.
Yeah.
So just lifting the lid on this, when did you get into blockchain and the world of DeFi?
I would say 2021. That was when, beyond just buying Bitcoin for the purpose of investment, that was when I really got into the space, right at the peak of the market. I always remember how Ethereum was $4,500 at that point. But yeah, that has been quite a journey to sort of start at the peak of the previous cycle, ride it all the way down now, and see a bit of the recovery.
Yeah. In my journey, given that you said that you lent into this and really got involved in 21, I might have been earlier then, because in my previous consulting firm, who are still growing and being very successful in the world of finance and technology consulting at Singaporean, we were experimenting on blockchain protocols and distributed ledger solutions, just in lab-based prototypes. But about 8 years ago, and I might talk about one of those use cases a bit more as we get into the conversation. But the narrative at the time was that this is going to be big. Where's the commercial use cases out there? And our sort of house view was always, they'd be about 5 years away. Yeah. But we were doing this in 2017.
Wow. Okay.
And now we're still saying it might be 3, 5, maybe more years. I mean, what's your view on the progress that's been made and the path ahead in the whole Web3 crypto space?
Yeah. I think you touch a point exactly spot on, Tony, right? Because I think, firstly, many people conflate the technology with the speculative nature. People think blockchain equals to crypto equals to Bitcoin, but I think that couldn't be further from the truth, right? I think what remains valid and clear is that blockchain as a technology has been maturing at a pace that's incredibly promising. And we see that use cases and that the experiments that are happening, actually many of them behind closed doors, even when the markets were at its roughest. I think the biggest difference since 2019, 2020 versus now, it's the number of financial institutions that are actually piloting or even starting to deploy blockchain in their technology, in their product and services. And why is that so important? I think it really brings a whole level of legitimacy, a whole level of credibility, and a whole level of trust that by itself, it's hard to bootstrap. Just take a very, very simple example. My parents, right? My parents, I would never be able to convince them to buy Bitcoin, no matter what. And that's me as their son. But if the bank, our local bank, the bank that has been around for 5 decades, or probably longer, right, comes and offers structured crypto products to my parents, they would be a lot more receptive, and they have been, right? And the local bank has already done it, right? So I think that's the idea of really that level of trust, of legitimacy that these institutions bring to the equation now that did not exist in the past. I think where we're still lacking, which is why I guess that's another 3 to 5 years around, it's the regulations need to catch up, right? Many of these institutions are close towards sort of going live, but really what's holding them back is a green light from the government to say, this is kosher, this is good to go. So I think we're almost there. And of course, the pressure is real. Even in the US, we see crypto this election cycle becoming front and center around so many of the debates, so many of the conversations. I think the golden moment has actually already arrived. It's just that we don't feel it, we don't know it, just because it's happening behind closed doors. And in my mind, that's exactly the spirit of it, right? Today, we use our banking apps. We don't care whether it's on Amazon Web Services, whether it's on Google Cloud, or what's the technology behind it. We just use it, right? And then we enjoy it. And I think that's really sort of the vision of blockchain adoption, when so many of us use it, but we don't need to set up our own wallets. We don't need to take custody. We don't even need to know what's a blockchain. So I think we're getting there, and it's going to be 3 to 5 years. I do agree with that.
It's really interesting what you said about trust, because this is, for me, it's a curious thing about blockchain, in that it inherently is a trustless, decentralized, node-based, immutable chain where there is no central body, and therefore you ought to be able to trust all the actors on it. But in the real world, I think we're seeing a gravitational pull around the brands and trusted bodies standing behind it. We've had the coin boom and bust, and so that's scared a few people off. It's made a few people rich and ruined a few others. And every time I talk to people about this space, that it's all about some big players putting their name behind something, and really that trust element that sits with the brand. And I was talking to someone just yesterday about crypto clearinghouse that is one of the ventures that is being worked on. And that again was about, and I said, well, why do you need clearing for crypto, isn't it? And it's apparently it's not instantaneous, and it's not trustless, and there's a market for this.
Yeah. I think that's definitely a case, right? I think at the end of the day, every trustless system began with some level of trust, right? Like every decentralized system began with some level of centralization, because I think it's been proven beyond reasonable doubt that the business, like, it's actually really hard to run an entirely decentralized process, just like how no real country or society out there can truly be democratic, right? Like, you can't be voting on every single decision, otherwise you just have a non-functioning country, but non-functioning organization. So I think some level of hierarchy is needed. And sort of my radical or sort of my facetious take on this is really that people don't really care whether it's decentralized or not. People just want it to be censorship resistant, right? Which I think at scale, the blockchain does able to provide that. But if you ask at the end of the day, do you care about something that's truly decentralized or not? I think most people wouldn't. The vast majority of people wouldn't, right? You're talking about a very small group of what we call crypto maxis or decentralization maxis that really sort of maybe have a loud voice. But for the large part, I think we can enjoy the benefits of blockchain without the need for, let's say, complete decentralization. And I don't believe it's going to be that case, right? So yeah, I think kind of we're at this state where we're finding what the right equilibrium is. But I don't think the answer lies in extremes, right? Where it's entirely centralized or it's entirely decentralized. Once again, we don't live in a world that's so black and white. Yeah.
No, I think people want to be able to trust the service, and fundamentally they just sort of want it to work, which is probably the same reason that we all give our data to big tech, because the benefits of using Amazon or Google or Apple, are far outweigh those perceived risks around the data sharing piece. But that's a different conversation. Let's just bring it back to real world digital assets. When we use that phrase, what assets do we actually mean?
Yeah. So I think the whole idea of real world assets is really about bringing financial assets onto the blockchain. It starts by firstly immobilizing that financial asset and then creating a representation in the form of a token on the blockchain. And really the whole principle, the whole idea of it, it's, can we move money in the broader sense of term, right? Which includes all financial assets. Can we move money at the speed of the internet instead at the speed of whatever that has been around for the past 50 years? There was a report that came out recently, and I shared it on my LinkedIn, that it studied what's the average time it takes for each currency to clear through the SWIFT system, which has been something around for the past 5 decades. The US dollar, which is the fastest, it takes 18 hours on average to move a US dollar around the SWIFT network. Now, let me give some context on 18 hours, right? The world's longest direct flight today exists from Singapore to New York, and that is 18 hours. So if I told you today, Tony, I need to send money to New York, I'm going to put a sack of cash on a Singapore Airlines flight and fly 18 hours to New York, you would call me crazy, right? But that, unfortunately, is the average time it takes to move money from on the SWIFT network. And that's USD, right? You're talking about a global reserve currency. Japanese yen, which is sort of what my parent company deals with, on average, it takes more than 44 hours, which is more than enough time to go around the world, right? On a flight. So the point is, look, today we're living in a world of internet. Today we're living in a world of AI. Everything happens so quickly. Yet money, the whole financial system, which is what so much of this is built on, is still moving at the speeds like 2 decades ago. So I think really sort of the idea of putting these financial assets on a blockchain, it's really about creating a more secure, right, a more censorship resistant way where we can move money, move assets at the speed of the internet instead at the speed of what things are today.
Yeah. And you're primarily talking tokenized currencies, so stable coins and token securities, or are you also talking about, the real world asset space, which I know has been out there in concept for quite some time?
Yeah. Look, I think all these exist on a spectrum. The most obvious and the most successful use case, of course, is tokenized dollars, which grew from something like 5 billion just in 2019 to 125 billion today on chain, give and take, right? So we're talking about this massive growth, this like 25, 30x growth that we have seen, really sort of driven, it really just changed the way we think about financial services. So I think stablecoins is the most successful example of tokenized assets on chain. The next asset class would be your fixed income, which includes your US Treasury bills, especially with the very high interest rates up until recently. That has been, of course, a great place for people to park their on-chain liquidity on. And then, of course, you have a whole bunch of other asset classes that I would say further down the adoption curve, right? From carbon credits to private credit to many others. Of course, it does eventually get into I would say, the esoteric, things like fine art, things like wine. I think those are more novelty, I would almost say gimmicky use cases that probably will take a lot longer to scale. Whereas I would say the more obvious assets that will get tokenized are those with liquidity and those with pricing transparency.
It's interesting. And I was talking about those early experiments that we did at Singaporean. One of the concept pieces we did at the time was token assets for real world property. So it was houses, art, wine collections. And we got as far as building some prototypes. And we did it with one of the big US tier one banks who took it out to their investor days. So there was a lot of buzz around this, but as you just said, this really hasn't gone mainstream yet. And I think it perhaps comes back to that trust point again.
Exactly.
Actually.
Yeah.
Okay, moving it forward slightly. To just packing this. So in the world of digital assets and managing those assets, the custody of those assets, etc., what are the technologies, protocols, coding skills? How do you build one of these?
Yeah. The good news, Tony, is you don't have to build it. Today, if you want to tokenize an asset, there's literally like dozens, if not hundreds of protocols or companies out there that would be happy to do it for you. I would go so far as to say that today, tokenization is already a commodity, and that no longer is a true differentiator, right? I think what's important is if someone wants to pursue that path of tokenization is to be very careful about, firstly, who your technology provider is, but secondly, and more importantly, which country, which jurisdiction, which court of law do you want to protect the asset or put the asset under? Because at the end of the day, the word real world asset, the emphasis is on the word real, right? So we haven't got to a state where most jurisdictions respect and recognize blockchain or code as the ultimate sort of source of truth. In matters of conflict, actually, it still comes down to what's on pen and paper, what's signed off chain. I believe we'll get there, right? I think Switzerland has already sort of pioneered the path of recognizing blockchain transactions as the source of truth. But for the majority of the world, unfortunately, that's still not relevant. So therefore, I think right now at this moment, picking the right provider who can guide you on the right jurisdiction to park your assets, to govern, how all this management, asset management, I think that's going to be a key consideration. So I think the technology, the tokenization itself, it can be done simply. So I think that's one on the regulation piece. The second piece that's of course harder. It's at the end of the day today, there's easily 1,000 companies, startups out there that are broadly tokenizing assets, right? Across all these different classes. We've met a good majority of them. And I think the biggest question, the biggest quest all of them are on is the source of liquidity, right? I tokenize my assets, but at the end of the day, I'm going to need people to purchase those assets. And still, they're still getting early pushback, right? From folks who are like, why would I take additional layers of risk and sort of smart contract risk, on-off ramp risk, hacking risk to buy the same asset when I can access it off-chain? I think we're getting some solutions to these problems, but these are some of the real challenges that startups are facing today.
Yeah, I guess there's a scale and an interoperability challenge there. Have you got an example or two of some of the platforms that seem to be sort of pulling ahead or perhaps leading in this space?
Yeah, definitely. Fortunate that we're invested in some of them. So one of them is called Open Eden. Today, they are Asia's largest tokenized T-bill provider. So what they did, right, it's essentially offer tokenized US T-bills, primarily for all these crypto native liquidity that exists on chain. I think why we invested in them, it's really because they excel on their regulatory and their compliance piece. They are fully compliant across the key jurisdictions like Singapore and Switzerland. They work with some of the most reputable banks and custodians like DBS in Singapore, like BNY Mellon. And most importantly, they were actually the first tokenized asset to actually receive a Moody's A rating. And I think that's massive, right? Because it's the first time Moody's, which is of course what we all know and what they traditionally rate traditional financial assets, the first time they have attached their name and their rating to a tokenized asset. And so I think all of this goes towards showing that, look, that confluence of traditional finance and blockchain is already happening. We're glad that Open Eden is sort of pioneering that charge.
No, I love that. I mean, that's a real DeFi, TradFi crossover right there. Moody's giving an A rating to a digital asset. So I didn't know that, but you hear these things from time to time, and maybe it's Goldman's opening a Bitcoin trading desk or something, or crypto ETFs being launched. And there are all sorts of steps, I think, in this trajectory for some of this going more mainstream.
Yeah.
What are the institutions doing at their level? Again, I think back historically, and when we were a bit more active in the early sector, there were experiments on bond issuance on the chain, and we all got very excited about it. And then someone would say, "Oh, but the dollar's actually moved on Swift." There were things like that going on. But where are the institutions at now?
I think institutions are very close towards deploying these and then really sort of offering it. We have already seen some early evidence of it, and it always follows a certain progression. And we have seen the same in traditional financial markets. First, these are offered to, I would say, institutional clients of these other institutional clients, right? Then you move down to sort of the private banking folks, then sort of like the premier banking, the mass affluent, before it finally reaches retail. And of course, the retail part, the jump to retail always remains the hardest. It always is the most scrutinized by regulators, and rightfully so, because their role is to protect the masses, right? But we have already seen sort of a lot of the adoption happening. Today, the vast majority of private banks, especially in Asia, have sophisticated crypto or digital asset offerings to their clients, right? And this is because they're recognizing that, firstly, their own clients are getting interested in the asset class, which is why the whole Bitcoin ETF thing took off at the start of this year. But more importantly, they are also asking questions about what's this whole blockchain thing. And many of the new wealth that's coming in is actually stablecoins or crypto wealth, right? So really sort of being able to meet the market where they are at is critical. Some people might be skeptical as to why do we need to tokenize assets. Look, there's $125 billion of stablecoins on chain, and most of them are just parked in wallets, right? They're not earning any yield. And think about it, across these banks, these financial institutions, everywhere is a land grab for AUM. All these institutions are trying to increase their AUM. They're just dangling all these amazing carrots when you sign up and deposit like $500,000 or $1 million with them. So really sort of this stablecoin market is a $125 billion market that is free for all to get, and especially important because if you are able to bring your tokenized assets on chain, you are borderless, right? Where you're able to sort of reach a global audience. So I think sort of these opportunities, while still early, to be fair, I think we are already seeing very clear signs that it's happening. And sort of as my role as an early stage investor, at the end of the day, our job is to take bets, right? It's the analogy I used to say, it's like if today I came to you, Tony, and say, hey, I'm fundraising to build a payments gateway. You would tell me I'm 15 years too late, right? Sorry, the time to build a payments gateway, the time to build a Stripe competitor, a PayPal competitor was 10 or 20 years ago. But today, of course, it looks obvious, right? Of course, payment gateway, we will all use it. Remember the time when people were skeptical on whether it's safe to put your credit card details online, whether it's even legitimate. So I think we're sort of at that phase with digital assets, right? Where there's enough signs to show that it is a real opportunity. But at the same time, it's not entirely consensus yet, right? It's not entirely well accepted that blockchain is the future of finance. And so that's why that excites me as an investor, right? I want to take the opportunity. I want to be early. Hopefully I'm right, but I think so far the signs are pointing towards that direction.
Well, sticking with the enterprise scale topic for a second, I mean, I've got one of the very established US stock trading brokerages coming on this show in the coming weeks, over $100 billion under custody, and they've got a very mature crypto offering. And I think there's another firm in my network with a huge market footprint, Franklin Templeton. They're very forward thinking in terms of both researching the sector and actually actively participating in quite a lot of what's going on in the DeFi space as well. But in your view, other institutions perhaps in the region that you would sort of mark out who are leading the pack on all of this at the institutional level?
Yeah. And look, I think, a lot of the innovation is actually happening with US-based traditional financial institutions. Of course, the likes of your BlackRock, your Vanguard, your VanEck, and all they're leading it. And I think what's most important is those are the public stuff, right? The public stuff that we all know about. But actually, where I sit out of Asia, it's pretty exciting because the innovation, at least on the, let's say, the product creation level, happens with the US financial institutions. But the liquidity and the money, a lot of it is still coming from Asia. Recently, I was on a panel. We just concluded Token 2049, which is, I would argue, the world's largest crypto event here in Singapore. And I was on a panel with some of the leading stablecoin issuers, right, at a conference. And look, they unequivocally say that 70% of liquidity comes from Asia, 30% comes from US, which in my mind was mind-blowing because when anyone thinks about liquidity, capital markets, US is always the king of it all, right? US is the largest, but what is clear is that the shift in balance is happening. And I think a lot of it has to do with, of course, the regulation and then whatever that the SEC is doing. But I think more importantly, on the enterprise level in Asia, we're seeing many of these local financial institutions are really stepping up and exploring. Of course, you have like Credit Saison as ourselves kind of very actively investing in the space. That's one form of participation. Another one, BRI, which is Indonesia's largest mortgage bank. Indonesia is the largest population in Southeast Asia, right? So the largest mortgage bank of the largest country in Southeast Asia is pretty significant. They themselves are tokenizing mortgages, are hopefully able to attract a more foreign investor crowd. And of course, in Thailand, right, the SCBX folks are also doing a great job, tokenizing different assets. Last year, they tried to tokenize a whole condominium as a proof point that it could be done. So I think there's a lot of these activities, a lot of these things that are happening. They might not always make the headlines, and they definitely don't make the global headlines, but I think they are very positive signals that the enterprises, especially the financial institutions here in Asia, are doing something about the opportunity.
Tokenizing a whole condominium, I quite like that. So you could sort of buy the bathroom, or when we were experimenting with the concept piece on this a few years back, it was about putting holiday home fractional ownership on Ethereum smart contracts, and it would come with a right or entitlement perhaps to stay there for 2 weeks a year or to share in the rental income. And you can absolutely see how you can encode these rules and models on the chain. I think it's a fascinating area.
Yeah.
I think something you said there actually was a probably nice link to the broader topic about the stablecoin volumes coming out of Asia as opposed to EU, US. Yeah. And curious whether you see that more broadly on the Asia fintech scene, because you're through the VC, you're clearly plugged in across the market. And I think that's probably wider than just digital assets. But what's your perspective on the sort of the health and what's going on in the Asia fintech scene?
Yeah, no, I think the Asia fintech scene has seen better days. That's the most honest truth, right? We are at a state where interest rates still remain relatively high, and I think in particular, of these fintechs have, I think many of these business models have been built predicated on cheap and low cost of capital. Of course, those days are over, and I think many of the fintechs, I would say, are struggling. But I think it's sort of overall healthy for the ecosystem, right? What we're seeing is sort of a natural, sort of like the Darwin evolution, right? Where the survival of the fittest is happening. So I think we're seeing a phase of consolidation. We're seeing a phase of fiscal discipline and prudence, as many of these fintechs have to figure out what they're doing to survive, right? In the past, it used to be lending. Lending used to be the be-all and end-all to all solutions, right? But I think what we're very quickly realizing is lending is also really tricky. We ourselves, the Credit Saison Group, core business is in lending. The one thing that we always tell, especially to, I would say, the more first-time fintech founders, is who are trying to do lending, any fool with money can lend out. The hard part is collecting it back. And I think sort of that's really sort of the core theme of what we're seeing, where we're seeing a survival of the fittest. The fintechs with strong underwriting, strong risk, strong collections capabilities are really standing out. We're fortunate to have some of them in our portfolio, but we're also seeing many that don't and are not working out.
Yeah, some really wise words there. I really like that. I mean, any fool can lend, but the hard part is getting the money back. And I think the same's somewhat true in the startup scene. It's very interesting, easy to have an idea, and in some ways to go build a product. But unless you've got the right level of commercial DNA, and we talked about it, product market fit, so that you can really build the pipeline and get your customers, then ultimately you're not going to have a business. And we see too few of those firms that actually have that very attuned commercial edge to them, I think.
Yeah.
However, from your portfolio, Qin, interesting firms in the startup space that you're working with or that you're seeing?
Yeah, I mean, I think the confluence of fintech and the blockchain is already happening. We have actually a London headquartered portfolio company of ours, BVNK, that's doing incredibly well. In the past year, they have cleared more than $2 billion in volume, in B2B cross-border volume, right? And actually, all of this is enabled via stable coins. Once again, most of their clients are not crypto businesses or crypto native businesses. They are just your traditional businesses that want to send money from point A to point B, right? So I think that really sort of embodies the belief that I have and also our investment beliefs. It's that the world of fintech, the world of blockchain is already converging, but for the most part, our end users don't need to know, they don't need to worry about it. And I think that will be really sort of the world that we're heading towards.
Yeah, that's a nice example. Actually, maybe we'll put the link to that company in the show notes, and folks can check it out.
Yep.
Look, we've talked about quite a lot, the world of real world digital assets and the wider fintech scene as well. And I sense there's a lot more we could talk about, but practically we won't have time for that. You've been an early stage investor. You've been an entrepreneur yourself. I don't know whether you're still 30 under 30, because I didn't ask you how old you are, but you've been doing this for quite a long time, despite the fact that you're probably a couple of decades younger than me. But what advice do you have for the entrepreneurs out there in the audience?
Yeah. Look, I think for founders, there's this one saying that's absolutely true, and I learned it the hard way. First-time founders focus on product. Second-time founders focus on distribution. I think that couldn't be more true, right? I think there's the biggest underrated ability, not just for founders, actually, for anyone out there, is the ability to sell. I learned that the hard way when I was at Glints. I dropped out of Stanford, got all these accolades, got all this PR. Selling is beneath me. That was what I thought, right? I refused to cold call. But really, sort of the company turned around when my co-founders and I, because of our investors really hard pushing, we started to pick up the phone, we started to cold call. And I think that whole idea, the whole learning of how do you sell, how do you think about distribution, how do you think about go-to-market, I think that still surprisingly is extremely underrated, because too many founders, and this is going to be another hot take of mine, too many founders are obsessed about product-led growth, right? Too many founders pray and hope that they can be the next Slack, the next Asana, that it's becomes the next Notion, right? Where they build such a beautiful product that people come in flocks. But I think what they fail to realize is that this is like a 1 in a million or 1 in a billion outcome that was a confluence of many factors. But there's so many other businesses out there that are doing very well just because they have good distribution. So that is my biggest lesson. Learn how to sell. Don't be afraid.
That is so true. And I couldn't agree more. I've learned this the hard way coming up through building and selling consulting companies as well. I haven't heard that phrase, the first founder is focused on product and second time founders focused on distribution, but it's a nice way to capture it. And it's absolutely fundamental that you're filling the funnel and generating demand for your product. I mean, for the audience out there, if you haven't read Dan Pink's book, To Sell is Human, that's a good one. And look at what Daniel Priestley put up on. He's done a lot more on YouTube recently on the Dent Accelerator program, which is all about building profile and pitching and generating demand. That's really bite-sized and super concise. So there's two really interesting things there. Yeah. From my perspective, which is a link to almost my penultimate question, Qin, which is what are you reading or listening to, or in fact, these days, when I ask people this question, it's as much, what are you watching on YouTube? What are you listening on podcasts as time to pick a book up?
Yeah. I follow almost religiously the Acquired podcast because the deep dives that those gentlemen do, it's insane. So they have done, so Acquired is this podcast that they do not 1 hour episodes like what we're doing here. They do 3 hour episodes. So I respect them for the amount of time they do, because they're over 3 hours, they deep dive, they unpack an entire business. And I think most recently, for example, they got Howard Schultz, which is the former CEO of Starbucks, on. So I think great podcast. They are listening, but of course, check London Fintech Podcast out first, and then go listen to Acquired, because that's a 3 to 3.5 hour podcast that even if you listen on 2x speed, it still takes quite a while.
That's so funny because I'm a huge fan of Acquired as well.
Yeah.
So those guys are West Coast VCs. So one of them used to work at Microsoft for a long time, and they were doing stories of it's really sort of a history lesson or growth stories of tech companies, but now they've broadened it.
Yeah.
And they actually covered LVMH and Hermes and and a whole bunch. And there's some episodes that are 3.5 hours long, and I've been listening to them. I commute on a motorbike in and out from the office, and I have a headset, and so I listen to podcasts on the way in and out. It's the only time I can find, to really focus in on something that long. But it's absolutely fascinating, and they're also amazing podcasters. So they do it as a duo, and it's a conversation, and it's incredibly well researched. So that's a show that just personally I sort of look up to. When you're a grown-up podcaster and you have 500,000 subscribers, and you're sponsored by JP Morgan, which those guys are, and they're actually doing an event.
Yes, at the Cheese Center or something, right?
This month.
Insane.
Where they've got more.
Yes.
So, it's extraordinary where a podcast can go at a different scale. Anyhow, so there's a big plug for Acquired. Maybe they'll plug this show. Who knows? Right. Where to find out more about you, Qin En, or any of the things that you've been talking about?
Yeah, stay in touch with me on LinkedIn. I do post quite a fair bit over there, and generally quite responsive to messages there. So, yeah, we'll include my LinkedIn profile, I guess, in the show notes, and I would love to connect with folks. And I guess my name is pretty unique, so there's only one person that's called Louis Qin En up there. So looking forward to connect with folks on LinkedIn.
Yeah. That's Qin En with a Q. For those who don't know how to find you. Yeah. Brilliant. Well, look, I've really enjoyed the conversation. Lots of fascinating insights in there, and I hope the audience agree. As ever, please share this around, like and subscribe. And thanks very much for coming on the show.
Thanks so much, Tony, for having me.